Everyone told you that life insurance was the responsible thing to do. But what if holding onto your policy is actually the least times responsible financial decision you're making right now? We're talking about billions of dollars in surrendered policies every single year. And the wild part is, some of those people made the smartest move of their lives. Let's back up and understand why this conversation even exists. Because it starts with a salesperson in a nice suit and a product that sounds like it does everything, protects your family, builds wealth, and basically tucks your future in at night. The reality is that whole life and universal life policies were sold as Swiss Army knives. But a lot of people are out here using a Swiss Army knife to build a house. The catalyst behind most surrender decisions isn't greed or impulsiveness. It's a slow, creeping realization that the numbers just don't math anymore. You've been paying premiums for 10, 15, 20 years, and your cash value looks less like a savings account and more like a participation trophy. There was a moment, probably sometime in the 1990s or early 2000s, when permanent life insurance felt like the pinnacle of sophisticated financial planning, and advisors were practically handing out policies like Halloween candy. Then the internet happened. Fee-only financial planners got loud. And suddenly, buy term and invest the difference became the rallying cry of a whole generation of skeptics. The psychological weight of surrendering a policy you've held for decades is no joke. It feels like admitting defeat, like you were sold a lie, and nobody wants to be the person who got played. But here's what behavioral economists will tell you. Sunk cost fallacy is the villain in this story, not you. Historically, the life insurance industry has cycled through waves of public trust and public skepticism, and we're currently living through a particularly spicy era of scrutiny. Studies have shown that a staggering number of permanent life insurance policies, some estimates put it near 30% lapse or are surrendered within the first 10 years, which tells you something about the gap between what was promised and what was delivered. Now, before you sprint to your insurance company's phone number, let's kill the biggest misconception right now. Surrendering is not always the power move, and keeping is not always the sucker's game. If you have a genuine lifelong dependent, a special needs child, a spouse with no earning potential, that permanent policy might be the most important financial instrument you own. The real question you have to ask is brutally simple. Is the internal rate of return on your cash value beating what you could reasonably earn elsewhere, net of taxes and fees? If your policy's cash value has been growing at 2 or 3%, while index funds averaged over 10% annually for the last 4 decades, the math is doing the talking, and it is not whispering. Here's a practical framework. Before you surrender anything, get an in-force illustration from your insurer and have a fee-only advisor stress test it against current projections. Also explore alternatives like a policy loan, a reduced paid-up option, or selling the policy on the secondary market through a life settlement, because surrendering is often the worst of several available exits. The life settlement market, where investors buy your policy for more than its cash surrender value, but less than the death benefit, is something most people have literally never heard of, and that ignorance costs policyholders real money every single year. If you're over 65 with a declining health situation and a large policy, a life settlement could put tens of thousands more dollars in your pocket than simply surrendering. Position size and discipline matter here just as much as they do in any investment decision. Don't let emotion, guilt, or a persuasive advisor push you into a choice that's sized wrong for your actual financial life. The person who surrenders a policy they genuinely no longer need, reinvests the cash value strategically, and redirects the premium dollars is not a quitter, they're a tactician. What this really comes down to is that the best financial decisions aren't made with loyalty to a product. They're made with loyalty to a process, a clear-eyed, unemotional audit of what every dollar in your financial life is actually doing. Whether you keep the policy or walk away, the discipline of asking the question at all already puts you ahead of the majority of policyholders who just let it ride on autopilot. At the end of the day, being comfortable with either outcome holding or surrendering is itself a form of financial maturity, because it means you've done the work and you're not just reacting to fear or nostalgia. Life insurance is a tool, and tools get evaluated, upgraded, or retired based on the job at hand, not based on how long you've owned them. If any of this has you rethinking your own policy or your broader financial strategy, check out our links in the description below, whether it's real estate investing, home contracting, work, or finding the right lenders. We can help you get started.